It's about time we did this. 5 levels for the overnight swing trade. Which one should you be using? So there are 5 levels of trading, and it's not about your skill level, it's more about your risk level. And unfortunately, most people were using level 5 unnecessarily when they really wanted to be using 1 or 2, but they really didn't understand the best approach. And quite honestly, I only want to use levels 1, 2, maybe sometimes 3, which we'll get into in a moment. We are overnight swing traders. We're active, risky traders who really don't want to do day trading, maybe don't have the time or even the patience to do it well. But we want to be active, so we get involved in overnight swing trading where we try to make money off of what we refer to as the overnight gap. You know the gap. The market closes at one point at the end of the trading day, and then the next trading day, it opens either up or down. But the question is there a way to understand what the probability might be whether the market opens up or down the next day so we know which direction to point our trade? And of course, that's where SPY Tomorrow comes in. We have a free indicator on the front page, either up or down at 4 o'clock Eastern Standard Time. Whatever system you use for your signal, you buy your options or your stocks or your leveraged ETFs at the end of the trading day. And then we wait overnight and we sell them the next morning, and that's where we get in trouble. And that's why we have these 5 levels. I think most of us really want to keep it simple, and we don't want the pain of day trading. However, level 5 kind of leads us into that direction. Really, this is what we want. Let me show you. Our portfolio simulation for our overnight swing trades is a helpful tool. It can help you decide where your comfort zone is as it relates to position sizes and help you set some goals and see a realistic outcome based on the way you wish to trade. So you can start off with a basic portfolio of say $1,000 and say a position size of 5%, average win rate. If you're not using the probability numbers, I would be very conservative. So you could say maybe 60, 65%. Let's start with 60%. And then the number of trades, 20 per month on average. So you could say 240 per year. So if you want to look at 1 month to see kind of the reality of what happens, click on Simulate. And as you can see, there are ups and downs. You can have a few up days, down days. See, these big days make all the difference. But you may still have a few down days. Look here, we had really 4 down days in a row, but at the end of the day, we were up. Now, if you want to see this play out, say 100 times, which is kind of like a Monte Carlo simulation that allows you to run the same thing over and over again so you can get a more even average result, so you can get a good idea of what might happen on average. It doesn't mean this is what will happen for you, but it can give you the average scenario in a more precise way. So we click Simulate after clicking the Monte Carlo. It tells us it's calculating. And here we go. So we can see what might be an average return, which is about 11% based off of a 5% position size. Let's put a 20% position size. Hit Simulate. And now we're looking at more of a 60% gain on average. You can also play with your win rates and the number of trades. If you want to look at it over a year, click 240 and Simulate. And there you go. But I do think it's important for you to look at various scenarios individually. So unclick this button and hit Simulate. You'll get the scenarios a little faster and see what it says after 3 or 4 times. It'll show you that everything doesn't always go perfectly. It's more of a reality. And again, you can play with these numbers until you find a position size based on an historical win rate over different time periods. For that kind of consistency, obviously, we need a signal that's better than 55%. And we also need to be consistent in our trading. So level 1 is simply this. We buy the same ETF or stock at the very end of the trading day, and then we set a time in which it automatically sells the next day. So wait a minute. What we're saying here is that we're going to buy at the end of the trading day and set an alarm to automatically sell, whether it's automatic or for us to do it manually, depending on the system you have, right at the open or maybe 10 o'clock. And yeah, that's what I'm saying. And then you say, well, wait a minute, then we may miss the peak of that move. We may miss the opportunity. Maybe the indicator's pointing up and then it goes immediately down at the open. We're going to miss that if we use this technique. That may be true. However, chasing that peak is how we're getting in trouble. Chasing that peak is how we're getting in trouble. Again, back to day trading. Chasing after that prime perfect moment to sell. And then when it doesn't work out, trying to make up for it and doubling down. Holding on to your options or your stocks too long. So basically what I'm saying is on average it's going to work out for you, whether you set your alarm for 9:30, 10, or 11 o'clock, which is when I'm setting mine for, and I'll explain why in a moment. But that consistent point in time, say 10 o'clock, will work out because yes, sometimes the market will be in your favor, then go the opposite direction. But then there are times it starts off in the opposite direction and is in your favor by 10 o'clock. So what I'm saying is over time, your indicator says up on a regular basis and hey, the market opens up and it says down and hey, it opens down. So overall, as long as you're above that 55%, 60% mark, and as you know, we're often around 70, 75%, in some cases even better, we're going to win in the long term. So with level 1, we're doing the exact same thing every time. The same percentage of our portfolio, the same ETF, stock, or option, and we sell at exactly the same time. In other words, we have one decision to make per day. And that really takes a lot of stress off of our trading, especially when we're not chasing the market around in the morning. Level 2 requires a probability number, and if you have any experience with your indicators, you know that some offer a higher probability than others. And the same goes for spytomorrow.com. We have a probability number, and it's anywhere from 50 to maybe 90% probability, meaning if it said 75% probability, that's 75% that it's going to be correct, either up or down, and 25% that it can be wrong. And it does actually correlate that way in our data. So in level 2, we actually position size before we trade. We figure out what that position size is going to be based on the probability, and then we trade that amount. That gives us a few more decisions to make before the close, but it also gives us an opportunity to maybe maximize more gains or minimize our position when, well, the odds may not be fully in our favor. Level 3, well, it's a little more complicated because it gives you the room to select the ETF or stocks you wish to trade on a regular basis. So maybe in levels 1 and 2, you're just trading SPY or QQQ. But in level 3, you will base your decision on market conditions or price action or maybe specific indicators. You could pick SPY or QQQ, IWM, or maybe a stock like Apple or Tesla. But it also goes a step further because in level 1 and level 2, we're generally just focusing on very small directional trades, where in level 3, we'll consider ratio trades such as 2-to-1, 3-to-1, 4-to-1, or 5-to-1. Meaning it allows us, say 4-to-1, to get a nice gain if the market goes in our direction, but if it goes the opposite direction, well, then we have a little security with that hedge. Still with level 3, it's just a one-trade system. The sell is automatic at a specific time of your choosing, but at the same time every day. You sell at 9:30 Eastern Standard Time at the open, or 10 o'clock or 11 o'clock. Now, I prefer 11 o'clock. It seems that like all the craziness is done by 11 o'clock, and quite often the market will peak and then reverse right after 11 o'clock. That doesn't mean it doesn't keep going some days, but overall I see that I can get the maximum out of my trade personally based on the ETFs that I have been trading and the options that I've been trading that 11 o'clock on average seems to be a really good time. But I would recommend you start writing down when you see the peak time. Is it at the open? Is it 10 o'clock? Is it noon, 1 o'clock? What seems to be the best time for you to sell? And then automate that every single day. I prefer trading levels 1 through 3 and mostly 2 and 3. However, number 4, level 4, gives you a little bit more latitude. So if you see market conditions changing, well then maybe you place a stop to protect any profits, or maybe a stop underneath the market if it's going back up your way, but protects yourself from any greater loss. Before I share level 5, which may be obvious to some of you, let me share my first week of trading like this, which I think is rather typical. Yeah, I remember my first week of trading like this, and it wasn't really that long ago. And yes, it was very counterintuitive. I bought that Friday and I set to sell at 11 o'clock the following Monday. And I got to tell you, the pressure was kind of off. I didn't have to worry about what was going to happen. It just was going to happen, whatever it was. And it turns out I made a small gain and did it again the next day, and it was a small loss. And then the following day, selling at 11, well, it didn't work out that way. Let me explain. I saw in the pre-market that everything was going my way, and I was going to be up probably 70, 80% at the open. So the instinct is, hey, save yourself, put a stop in there. The instincts were on full display. Make sure we don't lose money. And of course, you know what happened. I ended up putting that stop in about 10 o'clock. I had a half hour of patience and I was watching it go up and down, all the craziness of the first half hour of trading. And then I put that stop in and I got stopped out. And then of course by 11, you know what? It was up another 125%. And the thing is, if you look back at those simulators, you might have noticed that it says the maximum gain is 150%. Well, on that day, the gain was 250%. And it's those big days that really make our months and our years, and we can't miss out on them. Look, every day is not going to go our way, but if we do things that take us out of the game when the big opportunity is there, which has happened to me by just not even trading at all because I read the tea leaves and read them wrong. So I think ultimately the best bet is going to be the example that I had on Friday. Before we talk about Friday, of course, we need to talk about Thursday, which basically went my way. I made about a 25% gain on my trade, which is pretty good. And then at the end of the trading day, the indicator said down, mostly for IWM, so I bought IWM puts for the next morning. And of course, the next morning, IWM was pretty solidly down, and I knew that I had a good profit waiting for me at the open. Then I thought about Wednesday. I was like, you know, if I'm going to do this right, remembering those charts, it's not chasing the market each day, it's just buying at the end of the trading day, selling in the morning. And so I said, I'm going to follow through with my plan. Now, I didn't make quite as much money as I would have, but I stuck with my plan. And being able to stick with your plan and having that discipline will make me more money in the long run. So rather than making 70% on my trade, I only made maybe 50, 45% on the trade. But that's okay because I didn't chase the market around, which ultimately, when I start day trading, I tend to lose more money than I end up gaining most of the time. And of course, some of you are excellent at exiting manually in the morning. In other words, day trading your way out of your overnight positions, maximizing your gains, minimizing your losses. And I know you've heard me say that many times before. And that is for those who have the charts, for the people who are actually using the indicators well and have the discipline to follow through a day trading exit plan. It's not for most of us, but for many of us, we enjoy that. And I say we, but no, not really me. I like levels 1 through 3. That's just right for me to keep the consistency by just trading really one time a day. And of course, there are plenty of decisions to make which will affect how well we do with our trade, even if we're using levels 1 through 3. Deciding on which ETF or stock to trade. When is the expiration on our options when we're trading options? If it's closer to expiration, we're being more aggressive. If it's further out, we're being more conservative. How much of a ratio trade are we going to trade? Are we going to be aggressive with a 4-to-1 options ratio, or are we going to be a little more conservative with a 2-to-1 or possibly a very small directional? Are we trading 1%, 3%, 5%, 10% of our portfolio? Well, use the simulator and figure out which is right for you. We will certainly be talking more about these trading levels, and I'll see you in the next video.